Welcome to the Deep Dive, your shortcut for getting under the hood of market-moving earnings calls. Today, we're digging into Saia Inc., that's ticker SAIA. They just reported their second quarter 2025 results. Key player in LTL, the less-than-truckload sector.
Yeah, and our job for you, the listener, is really to cut through all the management speak and the dense numbers. We want to pull out the core insights, what really drove their performance this quarter, where they're headed strategically, and how they're handling the current economic climate.
Okay, let's jump right in. Headline numbers first. Saia reported GAAP EPS of $2.67 for Q2. And that was a pretty solid beat, right? Consensus was looking for something around, $2.41?
Exactly. A nice beat on the bottom line. Revenue, though, was $817.1 million. That was actually down just a tiny bit, 0.7% year over year.
So EPS up nicely, revenue basically flat, a bit mixed on the surface?
It looks that way initially, but what really got the market excited and frankly tells the bigger story was the operating ratio, the OR. It improved sequentially, so from Q1 to Q2 by a huge 330 basis points, landed at 87.8%.
330 basis points sequentially? That's a lot, isn't it? What's typical?
Yeah, it's remarkable. Historically, you might see maybe 250 to 300 basis points of sequential improvement, Q1 to Q2. So this was well above that. And in this kind of, let's be honest, pretty muted freight environment, seeing that kind of OR improvement, it signals really strong internal execution, cost control, efficiency. They're pulling the right levers.
Right. It's like they're flexing their operational muscles despite the weak backdrop.
Precisely. And the market saw that loud and clear. Very positive initial reaction.
Okay, let's unpack that OR improvement then. 330 basis points is impressive. What exactly drove that?
It really comes down to two main things. One, really disciplined cost control. And two, those network efficiencies we've talked about before are really starting to kick in. On the cost side, they cut cost per shipment by 4% just from Q1. That's significant.
How'd they manage that?
Well, part of it was a 4.2% reduction in headcount between March and June. But importantly, this wasn't big layoffs. It was more about managing employee hours, flexing them down carefully to match the lower volumes. Very tactical.
Smart. Respond to the volume you have.
Yeah.
And the network side. You mentioned those big investments they made in 2024, opening, 21 facilities?
Yeah, and that's where things get really interesting for the longer term story. Those newer terminals, the ones opened less than 3 years ago, they went from basically break-even OR in Q1 to a mid-90s OR in Q2.
Wow, that's a fast ramp up.
It is. Shipments per workday in those facilities were up about 4% sequentially, too. It just shows that building density in those new locations is working. The strategy is bearing fruit.
So it's not just having the new terminals, it's making them work efficiently.
Exactly. And they're also getting smarter about connecting the whole network. Management talked about redesigning line haul routes. Like they set up a direct line haul from Minnesota all the way to Seattle, cuts out touches, speeds things up, saves money.
Yeah.
And they're using triple trailers more, like in the Ohio corridor.
Triple trailers, like 3 trailers behind 1 truck.
Yep. Sounds wild, but it can cut line haul costs by maybe 30% compared to a standard single or double trailer setup. It's all about optimizing those long haul miles.
That's some serious efficiency gain. And they also changed their customer service approach, didn't they?
They did, yeah. Earlier this year, shifted it from one central hub out to the local terminals.
Why do that?
The thinking is faster responses because the local folks know the situation on the ground, plus maybe lower overhead and just getting closer to the customer. And the key is they seem to have done it without hurting service. Their cargo claims ratio, a good measure of service quality, was super low at 0.51%.
Okay, impressive internal execution. What about the external environment, pricing? How are they managing that in this softer market?
They seem to be holding the line pretty well. Contract renewals in Q2 averaged 5.1%. Management kept saying pricing feels rational.
So not a price war situation.
Doesn't seem like it. And revenue per shipment, if you strip out fuel costs, was actually up 2.7% year over year. They even mentioned that based on public data, Saia is still generally cheaper than some of the big national guys.
So maybe there's still room to increase prices down the line as they build out that national network. They have 213 terminals now, right?
That seems to be the implication. As they offer truly national coverage with good service, maybe they can command a bit more pricing power. It gives them runway.
And what's their view on overall industry capacity? We hear conflicting things sometimes.
Yeah, it's a good question. While Saia acknowledges some competitors might have empty dock doors here and there, their view is that overall LTL capacity, the usable, efficient kind, has actually been shrinking over time.
Interesting perspective. Less available capacity overall.
That's their take. And they feel like their investments in terminals and new equipment, and importantly, in drivers, put them in a really strong spot for whenever the market cycle turns up again. They're also embracing those NMFTA changes, the freight classification updates based on density. They see that as good for the industry long term, getting pricing better aligned with the freight characteristics.
Okay, so that covers the quarter and the current dynamics. What about looking forward? What did management signal for Q3 and beyond?
For Q3, the guidance was for about 100 basis points of sequential OR degradation. So the OR likely ticks up a bit from Q2's 87.8%.
Okay, a slight step back. Is that normal for Q3?
It is, yeah. Usually Q3 sees maybe 100 to 200 basis points of degradation historically. So guiding to just 100 is actually better than typical. And importantly, that guidance already includes the impact of a potential annual wage increase, which often happens in Q3 or Q4.
They're baking that in already. What about spending? Still investing heavily?
Yes. CapEx for the full year 2025 is still pegged at a pretty high $600 to $650 million, mostly finishing up the network build-out tech upgrades. But they did say they expect that spending level to start tapering off a bit in Q4.
And any color on how Q3 volumes were starting out?
At the time of the call, so looking at July month to date, shipments per day were down about 2.25%. Tonnage was roughly flat.
Still kind of sluggish.
Yeah, still a bit soft. And they flagged that comparisons get tougher in August and September because they opened a bunch of terminals in Q3 last year. So year-over-year growth might look muted just because of that base effect.
Makes sense. Zooming out again, the long-term picture, what's the ultimate goal management is painting?
They were pretty clear about it. Strong conviction in the long term. The ultimate goal. Get the business operating with an OR down in the 70s.
And 70s. That's very ambitious for LTL, isn't it?
Extremely ambitious. But it really raises the key question, right? How much operating leverage is actually built into the system now? As those newer terminals mature, as density builds, as they optimize with things like triple trailers, what's the real earnings power once things normalize or improve? They seem to believe it's substantial.
Okay, let's connect this back to the listener, the investor. The market reaction on the day, July 25th, was pretty dramatic. The stock gapped up almost 13% in pre-market, finished the day up 7%. Big volume, too, like 3 times normal.
Yeah, it was a powerful reaction. And I think what's fascinating is investors clearly looked past the slightly lower revenue, past the cautious Q3 comments, and they focused squarely on that OR beat, that sequential improvement. They saw it as better than feared.
So execution trumped the macro concerns,
Yeah.
at least for that day.
It seems so. It suggests the market is willing to give Saia credit for controlling costs, for optimizing this big network they've built, and for positioning themselves for when freight demand eventually picks up. It really feels like a bet on the internal improvements they've made, believing those structural advantages will pay off big time down the road.
All right, this brings us to our segment. This is not financial advice, where we toss around an outrageous but plausible trade idea based on what we've just discussed. Remember, do your own research. This is purely informational.
Okay, so given Saia's execution, the network leverage potential, and management literally saying they think this business can operate in the 70s or R range eventually. Here's an idea. Let's call it the 70s or long call spread. The idea is you go long a call option, maybe moderately out of the money, say 6 to 9 months out.
Okay, so betting on upside.
Right. Betting on maybe a broader industrial pickup, plus Saia really starting to monetize these newer terminals fully. But to manage the cost, you simultaneously sell a further out-of-the-money call with the same expiration date.
Creating a call spread reduces your upfront cost, but caps your maximum profit.
Exactly. It lowers the cost of entry significantly. You get a decent return if the stock moves up, maybe driven by even a modest freight recovery. And Saia's OR dropping towards the low 80s, maybe even hinting at the upper 70s like they aspire to. Management said, and I'm quoting loosely here, this business, we don't see why it shouldn't operate in the 70s, and that the incrementals can potentially be pretty good.
So you're playing for that structural re-rating as they scale into the network.
Precisely. It's not just about one good quarter. It's a bet that as the macro turns, their disciplined build-out translates into significantly better profitability. The sold call limits the moonshot, but it funds the core conviction that the market will eventually recognize this leverage. You're buying the story that execution now equals outsized profits later.
An interesting way to structure a view on that long-term leverage potential. Okay, so let's wrap this up. To recap, Saia's Q2 really showed impressive operational control. That OR improvement stood out against a tough freight backdrop. Clear progress optimizing that big, expanded network, focus on costs, efficiency, rational pricing seems like a solid playbook.
Yeah, the long-term story, driven by getting those terminals mature and leveraging the density, it definitely seems intact, maybe even strengthened this quarter. And that really brings us to the final thought for you, the listener. If Saia hits anywhere near that 70s or our target long-term, what does that really mean for its value? Are investors fully appreciating the profit potential embedded in this network they've so carefully constructed, especially once the economy lends a hand? Something to ponder.
Indeed. Thanks for tuning into the Deep Dive. We always appreciate you joining us and welcome your thoughts or ideas for future topics. Until next time, happy investing.
Disclaimer. The views and opinions expressed in this discussion are for informational purposes only and do not constitute financial advice. Investors should conduct their own due diligence and consult with a financial professional before making any investment decisions. Investing involves risks, and past performance is not indicative of future results.